Welcome to the Defenders of Business Value, the podcast that helps business owners unlock the value they've built and exit on their terms. I'm your host, Ed Mysogland, and for the last 30 years, I've been helping business owners prepare, grow, protect, and ultimately sell their businesses. Whether you're a business owner, a buyer, or an advisor guiding others through the process, if you want to make your last deal your best one, you are in the right place. So let's get started. Welcome to the Defenders of Business Value podcast. It's been a minute since we've had an opportunity to visit, so I'm looking forward to reconnecting and seeing how we can get into some trouble together. Defenders of Business Value, it's for buyers, sellers, and advisors of businesses. And what we do is we talk about valuation, we talk about deal making, we talk about what makes a business saleable. That's what we've done for 121 episodes, and we'll continue to do for 121 more. Seth Godin always had a statement, would they miss you if you were gone? And so for those of you that have reached out and, missed new content, let's just go ahead and address it right now. First things first, if you don't have anything new and relevant to say, I just don't think that I should take your time by having you listen to a podcast for the sake of consistency. The time from our last episode to now season 3, there hasn't been a lot other than a change of White House leadership. And after the dust settles, then now we can start putting content together on what that means for the small business community. I think the older I get, the more sensitive I am to wasting people's time. I'm not going to tell you the same thing over and over and over again because you have all kinds of people now saying the same thing. So if there's something new, exciting, and different, I want to share it. And so that's part one. Part two, elder care. That strikes every family, and ours is no different. And so we spent an awful lot of time transitioning my wife's mother into assisted living, and that is a no-joke time consumer. So anyway, that's where we've been for the last 9 months between episodes. And for the 14,000 of you that continue to subscribe to the newsletter and enjoy the stuff we talk about on valuation and deal making, we're back. And for those of you that don't subscribe, you should. There'll be a link in the show notes for you to do that. Because again, everything that I write about, whether it's on LinkedIn or the other social platforms, I do want you to get it because I don't talk about everything that we share here on the podcast in the newsletter. I'll link to it. There's little articles and things like that you might find interesting. Okay, so today I wrote an article on LinkedIn about rethinking the silver tsunami. So for the better part of a decade now, we've been told, and when I say we, anybody that has to do with the business sales have been, running around, the silver tsunami, we're going to be overrun with business owners having to sell their business, so you got to sell right now. And that just hasn't happened. Most deal-making shops worth their salt? Absolutely. We're all up. Business is up, but are we being overrun with new sellers coming in that we can't possibly take on more business? Absolutely not. And so in today's episode, that's what I want to talk about. I want to talk about rethinking the silver tsunami. And, I found a lot of data that supports my opinion as to why business owners are holding on to longer than expected to their business and what that means for buyers and sellers and advisors. So let's get into it. Basically, the silver tsunami is about 10,000 people a day, all right, are turning 65, of which 19% of them own small businesses, so the baby boomers. And so where I think this goes off the rails is that it doesn't tell the whole story, because what really happens here is that owners are living longer. And here in our practice, we're no different. I've got some aging partners that are into their 70s now. They're still relevant, they're still competent, and they're rocking along. I mean, as far as their personal production, it's hard to argue with that. So why would you exit if you're still relevant, competent, and still making impact? And so that retirement cliff, just because you hit 65, does not mean that you're riding off into the sunset. Some stats that I'm citing here, it seems as though the 65 is closer to 75 before people start thinking about when I say people, I'm referring to business owners, start thinking about exiting. And so if you've worked with owners, most business owners just don't wake up and say, you know what, today's the day I'm going to sell my company. It doesn't work that way. So that's the first thing, is that this is really a kind of a slow moving thing. It's and for any of those that are in the exit space, when I say exit space, like exit planners, those that are doing sale prep work, which we do a lot of, the long and the short of it is this, that it takes time, right? We always say it's probably a 6 to 12 month kind of getting your arms around selling, that do I want to do this? So we talk about valuation, tax implications. Is your family ready? Is there some charitable gifting that you want to do? Is there some strategy that we can deploy before we go to execute the sale? And then you have the sale process that runs anywhere from 1 to 12 months, with the median being roughly 7 months from start to finish. And then chances are there's going to be a transition, and that could be 30 days to a year. And so you look at that exit window, it's a 3-year process. So my point is that this is a slow moving process through the exit. Everybody wants to know why, and it's really because of math. All right. So if you've ever heard the term, the principle of substitution, right? The principle of substitution means, why would I pay for more for something of equal utility? And in here, in what we're talking about with exits and why this isn't a tsunami, but rather a slow moving tide, it's the math doesn't work. All right. Selling a business means giving up a high yield, right? So a highly profitable business. It's tax advantage, and it's moving into something that is a lot less rewarding, but more risky. When you think of business owners, it's about control. It's always been about control. And so when a business owner is sitting here thinking about, am I interested in losing control of my destiny? Because you got to remember, when you talk about business owners, we're talking about people that have controlled everything in what's in their world. And when I say that, when you start giving up control, they perceive it as risk. And candidly, it is. And let's just talk a little bit about returns, right? Typically, the return on investment for a business tends to run anywhere from 25 to 50%, right? And after paying the return, where you deploy your capital, right? Let's just hypothetically, we sell the company. You sell the company for $1 million. You pay your taxes, and you're probably at $600,000-$700,000. Where are you going to put your money that you get the same kind of return that you're getting owning and operating the business, right? So why would I deploy my capital into an investment that's getting me 7 to 10%? While it's great, and the big thing is liquidity. You can get that investment back in a hurry. Selling a company, an illiquid asset, takes time, but nevertheless, the returns tend to be at least 5 times greater. So why would you substitute that? And that's the hard part. Is it's not because they're selling out of fear. They're just refusing to trade their return on investment of owning and operating with something else that's inferior. Also, you have to remember that the stock market's running at all-time highs. After you pay your tax, where's the market going to go? Are you able to, as quickly, grow that investment? And the answer, probably no, not nearly as fast as you can appreciate capital in your own business. All right, so what does that mean? And this is more toward business owners. And this is what happens. Business owners just keep drawing on their returns or their cash flow of the business, and they stop reinvesting. They keep on pulling money out. They don't want to buy that new piece of equipment that's going to grow the business. Because remember, growing the business costs money. And when it costs money, it's coming from someplace, and it normally is coming from the owner. So many business owners just stop reinvesting, or stop reinvesting to the extent that they historically have that grew the company to where it's at. The problem that the business owner doesn't recognize is that the business buyer does. The buyer recognizes that you didn't reinvest. And we've had many companies over the years do this very same thing, where a piece of equipment or infrastructure needs to be reinvested. And they didn't do it. All right. So now the business buyer comes along and says, well, wait a second, this piece of equipment has to be replaced, and you've been band-aiding it, and the cost associated with keeping it running is so great. What the buyer does is they penalize the seller's value to cure the problem. And then the seller's like, you got to be kidding me. You can't penalize me because of equipment that you're going to have to buy. But the buyer's position, and rightfully so, is like, look, the utility of the asset I'm buying is inferior. And so why would I pay you full price if day one, I'm going to have to go replace this piece of equipment? And that's why a lot of business sellers tend not to be able to sell, is because they don't recognize how the buyer is coming in and looking at the business. And it's a real issue. I implore the sellers to continue to keep doing what they've done to grow the business, because chances are, I mean, if you look at the investment and then you put, a 3 to 7 multiple on the investment you make, right? I mean, you're going to recover it, all right? You're going to recover that value, or at least preserve it, is the other way to look at it. And so as we look at the crystal ball, that will be probably the biggest challenge that most business owners will face, is that hoarding cash to fund their semi-retirements or their retirements. They're going to keep pulling cash out. And again, by the way, this isn't judgment. If a business owner is doing that and they're eroding the infrastructure of their company, so long as they understand that, I mean, that's great. The challenge is when you don't understand that. If you're planning on not reinvesting in the company, but hoping to get maximum value, it just isn't going to happen. Most buyers at this stage, right, they know a ton more about businesses, right? They're looking at lots of them. And candidly, they're not going to make a stupid financial mistake because you chose not to do what made you successful in the past. And because what they're looking at is, what do I have to do? Because they're going to borrow a bunch of money to buy your business. And the issue that you have to contend with is that they're making a forecast, and that forecast includes capital expenditures. And so if we look historically and you're not making them, in the future, they're going to have to make them. And as you start making those investments, your earnings start reducing, and they can't pay that much for the business. So as we wrap this one up, here's 3 things I want to kind of just draw your attention to. 3 quick little bullets here. So for buyers, look, you absolutely need to stop assuming that business owners are absolutely hell-bent to exit, right? They just aren't. Back to the control thing. It is easier for us as business owners to not make a move and control, for good or for bad. All right, so your job is to earn some trust and expect a longer process for an exit. Unless they're under duress, it's not an urgent exit. And if it is an urgent exit, then chances are it's going to be, as you know, a discounted exit. So advisors, I'm anti-fear-based messaging. Like, oh my gosh, the sky's falling, all these buyers are going to go away. And if you don't get your clients to sell now, they'll probably never have maximum value. Candidly, as a professional advisor, that's just not the case. Good businesses sell in any environment, period. I've been at it 33 years. I'm telling you that is the case. Their fear-based messaging in this environment is just, it's wrong. And candidly, it doesn't look good on the profession itself. I understand that it works for a lot of other industries where fear rules the game. But in our case, it should be, here's how you can maximize your exit. And what we should be as a collectively saying is you need to not take your foot off the gas until that check clears or that wire hits. You do not It is business as usual, and you will never regret doing so. And then lastly, for business owners, continue to reinvest and prepare and stay in control. It doesn't matter how you want to exit. You can be carried out from behind your desk, and there is nothing wrong with a exit that way. So long as the people that know you and love you know that is the plan. And that's the real challenge, is evaluating your exit channels. Holding until it's sold out of your estate, nothing wrong with it. If you want to sell to a third party before you get to that point, nothing wrong with that either. But my point is that's the whole exit planning thing. Understanding what it takes to sell a business, because you can then back into how you would like to do it. And look, we do it all the time. I mean, we've got sellers we've worked with for a decade, and we have those periodic conversations, what's changing in the market, and that's why we're in it. So if you have questions, holler. I'm happy to visit through it and tell you what the research says and how we can help you. To kind of wind this up, the silver tsunami may never, ever show up, but the tide absolutely is changing. And owners who prepare early, think strategically, and protect the value that they've built are the ones who will win. They always have been that way whenever they decide to exit. So it's good to be back. Thanks for listening to the Defenders of Business Value podcast. I hope this episode resonated with you. Please share it with other business owners and advisors. I'll link to my article that kind of caught fire for you business owners that are in your 60s and 70s that listen to this. I think it'll resonate with you. So it's been a pleasure, and I'll see you next time. Thanks for listening to the Defenders of Business Value. If today's episode helped you think differently about building or selling a business, follow the show so you don't miss what's next. And if you want to become a more informed, confident owner, the one who knows how to grow, protect, and eventually exit at maximum value, subscribe to my newsletter. The link is in the show notes. And if you're ready to talk about your next deal, connect with me on LinkedIn. So until next time, we'll see you soon.